Welcome back to Economic Outlook. In my previous entry, I spoke about why the crisis in Greece remains a threat to global financial markets. Today I want to explain some of the mechanics behind individual transactions precipitated by the crisis in Greece. The relationship between currency, bond markets, and equity prices is difficult to quantify and understand. So what I want to do is look at some of the fundamental transactions that are taking place because of the crisis in Greece, and use these transactions to explain the more macroeconomic trends that are occurring because of the crisis. The first and most obvious result of Greece's situation is an increased cost of borrowing money. Today, public debt in Greece represents 120% of the country's annual GDP. The government in Athens has been forced to borrow more and more money to meet old debt service payments and finance substantial government entitlement programs. As borrowing has increased, so has the risk of default, and investors have responded by demanding a higher yield on loans to Greece, which take the form of bond purchases. The relationship between bond prices and yields is often misunderstood. Bond yields move in the opposite direction of bond prices. In their most simple form, bonds represent loans. A government, and in this case Greece, issues bonds to investors in return for money up front. As this chart shows, Greece will receive payment today in return for a promise to repay the bond principal with interest at a later date. The amount of money Greece receives in return for this future payment is a function of the country's debt rating. Countries or businesses which have a low likelihood of default receive more money up front for a bond issue than a less creditworthy entity. The rationale is straightforward. Investors will only accept more risk in the form of default if returns are higher. Higher returns come from paying less money up front in return for the same future payment. For example, the United States Treasury bonds are widely believed to be the most safe and secure fixed income investments available. In return for a $100 payment in 1 year, an investor might lend the U.S. government $97 today. This corresponds to a current yield of 3.09%. The investor loans the U.S. $97 in return for a payment of $3 in 1 year, plus the original loan amount, $97. If an investor wanted to loan money to Greece or another risky entity, what would she do? If a country defaults, she loses both her principal and the interest payment. Assuming she wants to receive $100 in 1 year, the same as she could have gotten from the United States, she will account for the increased risk of default by loaning the government less money in return for the promise of a $100 payment later. She might lend Greece $80, which represents a current yield of 25%, or maybe even less. Yields increase because the investor will pay less money for the same future payment. However, this increase coincides with a greater risk of default, where the investor will receive nothing in the future. From the Greek perspective, the increased yield presents a fundamental problem. If the country must raise a fixed amount each year, it has to issue more bonds when yields increase. Interest payments increase proportionally, and more pressure builds in the financial system. When the cycle is repeated, yields increase once again to reflect the old loans, and so on. So for example, assume Greece needs to borrow $1,000 today. If yields are at 25%, it has to issue 12.5 bonds, or $1,000 divided by the $80 it would receive for each bond it sells. In 1 year, Greece has to repay $1,250. So when it issues bonds in the next year, it needs to raise more money to cover these interest payments of $250, plus whatever it needs to meet its new spending. Yields will increase. So if the yield is 30%, Greece has to issue 13.3 bonds for its $1,000 expenses, and another 3 bonds to cover its $250 in interest payments. So this cycle continues over and over until either yields fall or the country becomes insolvent. At this point, you may be wondering whether a country can actually reverse a cost spiral and whether or not yields can be lowered. And the answer is that they can, but only through careful fiscal policy and reduced government expenditures. In the example I just gave, Greece tried to borrow $1,000 every year to meet government expenses. If instead Greece tried to borrow only $500 per year, investors might decide that the country had adopted a more sustainable fiscal policy and that it was a lower credit risk. Then yields would decline, Greece could borrow at more reasonable costs, and the cycle would be averted. This is why Greece has attempted to introduce austerity measures and reduce government expenditures. However, these measures have met with violent protests from Greek citizens who don't want to lose lucrative entitlements from the government. This has caused many leaders to question whether or not the people in Greece will actually accept the EU and IMF bailout and adopt the austerity measures needed to reduce borrowing costs and return their country to a fiscally stable position. Although the example I just gave is very stylized, it does represent many of the realities facing investors in Greece. The situation is actually more pronounced because of the precarious state of other large economies like Spain, Italy, and Portugal. The potential for a cascade of defaults from Greece to Spain to other countries in the EU and beyond creates the risk of bank failures and increases borrowing costs for all of the countries involved. This puts stress on the entire structure of the European Union. As I discussed in my last video, there is a possibility that the Euro and the European Union could actually dissolve because of this crisis. It's not necessarily the most likely outcome, but it is a possibility, and investors have to mitigate this risk in some way. And one of the ways they do this is by selling the euro currency and purchasing currencies in other denominations like the United States or Australian dollar. These countries are perceived as more stable than the euro, and therefore investors mitigate risk of potential disaster in Europe by buying these currencies and selling their euros. These currency flows affect exchange rates. For example, the euro has depreciated against the US dollar considerably because of stability fears. This chart shows how the value of the euro has fallen relative to the dollar. As investors bought dollars, the natural forces of supply for euros and demand for dollars pushed the exchange rate down. It now takes more euros to buy dollars, reflecting the increased risk associated with the euro currency. The loss of value in the euro and the rising value of the dollar have important implications for markets in the United States. The first and most logical outcome is an increased demand for US Treasuries. Investors perceive risk in European debt markets and seek safety in European Treasuries. This reduces yield for US debt instruments and increases their value. And remember, yields decline if people are willing to loan money for lower returns. Although the United States faces its own substantial debt problems, investors view the situation here as more stable than in Europe at the moment. Therefore, as the value of the dollar has increased, money has flowed into United States Treasury markets and out of European debt markets. In my next entry, I will examine how the crisis in Europe has affected domestic equity markets, as well as markets for commodities and other goods. Thank you for joining me here at Economic Outlook, and as always, be sure to check out my website at www.econoutlook.com for new information, and I'll catch you next time for the conclusion of my look at the crisis in Greece and its effect on domestic equity and treasury markets. Thanks as always, and I'll see you next time.